Good evening and welcome to a new weekly market wrap. My name is Daniel Ang. Today, of course, is January 11, 2026. We have just finished one full week of trading for the new year. Now, let's just recap what happens in the past week and what to look out for in the coming week. Now, before we go into the content itself, let me remind you that this presentation is for educational purposes and it does not constitute investment or financial advice and is not intended to be a solicitation for the purchase of any financial instruments or service. And this presentation may contain forward-looking statements, including opinions, which is my own, forecast, expectation, or conclusion based on current views and assumptions. Now, these opinions are subject to known and unknown risks and uncertainties, which could cause actual results or events to differ materially from those expressed or even implied. Now, this presentation is general in nature and does not constitute a professional advisory relationship. Attendees should consult a qualified financial advisor or legal counsel before making any financial decision or taking any action. So, with this out of the way, let's get started. Now, let's recap the key events for the past week, starting with last Saturday, which is the first trading day for the year itself. That was the day after the first trading day for the year. So we all knew that on Saturday, which is January 3rd, the U.S. actually attacked Venezuela, which is a country in the South America, and this has been ongoing for some time because the Americans Navy has been positioning military assets in the Caribbean, waiting to strike Venezuela. The excuse at the beginning given by President Trump was to eliminate drugs trafficking, okay? And he has accused the president of Venezuela for being a drug lord, okay? So basically, that was the excuse. But we all knew that it was all about Venezuela's resources, in particularly its crude oil, okay? And Venezuela has supposedly one of the largest oil proven reserves that we know. And obviously, America would be very interested to get their hands on those crude oil. Beyond crude oil itself, Venezuela is also known to have massive resources in terms of precious metals, minerals, and whatnot. So this was what happened, and they managed to uh, snatch the president during the night, in the middle of the night. So basically, that was what happened. And on Sunday, President Trump actually threatens the other countries around the Latin America, in particularly Colombia, Cuba, and Mexico. And he also mentioned that he wants to annex Greenland. So that caused a little bit of a stir among all the allies in the European Union. Then, of course, we have the replacement or so called interim president of Venezuela, which was a deputy president before the president Nicolas Maduro was snatched. So she became the interim president, and that she is not playing to the tune of the United States. Basically, she put up a defiant attitude and saying that, okay, Venezuela needs to protect their resources, okay? And on Tuesday, which is January 6th, we have European leaders coming out in support of Denmark because Greenland is essentially owned by Denmark. And the EU came out to say that if there's going to be any attack on Greenland, then the European nations will not rule out any possibility of actually coming to Denmark's aid, meaning to say that they may comes to Greenland's defense militarily. So that is signaling a break in the transatlantic military union, which is NATO. Okay, so on midweek itself, on January 7th, President Trump said he wants Venezuela to hand over 50 million barrels of oil to the United States. So not sure whether he will be able to get so much oil because after years of sanction, the oil industry in terms of the capacity to actually drill for oil has been greatly been affected. Okay, so the facilities is not able to pump out 50 million barrels of oil as what President Trump wants. Okay, so the next day we can see that President Trump again say he approved a bipartisan Russian sanction bill. Now this is escalating the conflict in Ukraine between Russia and Ukraine with the help of the West, principally NATO. So he did mention that he is prepared to slap a 500% tariff on countries that continues to buy Russia oil. Of course, this has to go through Congress before it can be legislated. Okay. Then on Friday, which is the last trading day for the past week, we have U.S. tariff rose to 18%, prompting China to reorient its export towards Europe, Mexico, and Canada. Oh, sorry, I beg your pardon. Here is supposed to be the non-farm payroll, not supposed to be what I just mentioned. So it is non-farm payroll, which is the most watched data set for the entire month. Okay, so the number that came out wasn't very pretty, but it wasn't that bad. But by and large, we can see that the Federal Reserve, which is a central bank, would have less incentive to actually cut rates in January, which is this month. Okay, so this has been what happened in the past week. So now we go and take a look at what data has been released this past week, in particularly those for the United States. Starting with Monday, we have the manufacturing purchasing managers index. So we knew that there are two sets of purchasing managers index that are regularly being released. We have one which is called the ISM, stands for the Institute of Supply Management. Now this is the one that I normally look at, which is the ISM manufacturing PMI. Okay, so the previous was 48.2. Now this is bad because 40.2 means it's below 50. Any number that's below 50 points to contraction in that sector. So we all knew that U.S. manufacturing has not been the key driver of economic activity in the United States. Services is the one that we want to take a look. So it is not surprising that the manufacturing sector continues to shrink. So we can see the latest number shows that it is 47.9, which is worse off than in November of last year. The market was expecting slightly better result at 48.3, but it came in at 47.9. So this is no surprise, but it is definitely the weakest number for 2025. So this points to continued weakness in the manufacturing sector as far as the US is concerned. Now we have this services PMI, which is the sector that has been supporting growth in the United States. After all, the US is very much a service-oriented economy, very much like the UK. So this is a sector that has been doing very, very well. In fact, for the whole of 2025, you can see that except for two brief periods in May as well as in September last year, which is bordering on 50, the rest of the year, we can see that it has been relatively very, very buoyant. And the December number came in the strongest for the whole of 2025 at 54.4. Market was only expecting 52.3. So this is 2 percentage points better than what the market has been expecting. So that gave Wall Street a boost in the sense that the services sector has been very, very resilient despite all the ups and downs, especially the chaotic nature of the US tariff. So it has not really affected negatively the US service sector. Okay. And here we have the private employment data coming out from the ADP. So this is ADP Research Institute's number. We can see that the previous numbers for November last year was a negative 32,000 jobs creation. And this has been revised somewhat better to negative 29,000 jobs that has been lost. And the consensus for December was a positive bounce up of 47,000. It came in not so bad at 41,000. So 41,000 is not bad, but you can see the whole of 2025, even at 41,000, is not that great a number, but at least it is above water. Okay, so that has actually give the non-farm payroll, which is expected to be released 48 hours later, a somewhat positive spin, okay, so to say. Then the actual number that we can see, the US labor report, in particular the non-farm payrolls, we can see for the number December, it came in not that bad. The market was expecting 55,000 jobs creation. It came out 60,000 jobs. There was we We can see that on the chart on the left, I have two colored bars, one in blue and one in orange. In particularly, you want to take a look at the one in blue. Okay, the blue are the revision. Now, typically, if there's going to be any revision, it only goes back maybe 2 or 3 months before the latest number has been released. But what we saw in this past Friday's update in the non-farm payroll, they actually revised the entire 2025 data set. So what it means is that for the whole of 2025 sets, for the whole of 2025, investors and policymakers has been basing uh, their views on suspicious data set. Okay, because it's very, very rare that they need to actually revise the entire year data, which I've never seen in all my 40 years of trading. So this is very, very suspicious. So it also lays claim to the fact that more and more analysts are beginning to doubt the reliability of US data, especially from the Bureau of Labor Statistics. And on the other side, we can see that there's another chart showing unemployment rate. We can see unemployment rate came down from 4.6%, which is in November, came down to, yeah, correct, yeah, to to 4.5. So it has been marked down a little bit, but 4.5 is still very, very elevated. And of course, there's a gap in between October. There was this government shutdown for 43 days. So there was no data collection, and therefore we do not have data for October of 2025. But by and large, you can see the trajectory suggests that unemployment rate is on the rise. And this is concern for the Federal Reserve, whether they want to continue to cut interest rates going into 2026. Now, this month in January, there is a FOMC meeting. Consensus is that it is very likely the Federal Reserve will stay their hand, meaning to say that there may not be any interest rate cut for January. Okay. So this is the number that came out. We can see that the non-farm payroll has been seriously revised, and that is a problem for me because I have never seen a revision that goes back all the way to the beginning of 2025, okay, which is an entire year's worth of data. Okay, so this is something that I am very, very upset about because we have been operating in an environment whereby data sets cannot be reliable and is becoming very, very suspicious in my opinion. Okay, so going forward, okay, next month will we get something similar to what we have just seen? Not sure. Okay, so there is they released the last number for the last data sets for this past week has been the Michigan Consumer Sentiment Index, and this has been collated by the uh, uh, University of Michigan. You can see that consumer confidence has bumped up a little bit to 54, which is still very, very weak considering the whole of 2024 all the way to the end of 2025. The trajectory suggests that the consumer confidence is actually on the way down. So we have a little bit of an uptick, but it does not do a lot of good for the sentiment itself. So sentiment as far as US consumers is concerned is definitely on the down and down. Okay. Now, what to look out for in the coming week? We have quite a bit of full calendar here, starting with Tuesday. We have the UK releasing their labor reports. Okay, no consensus here. And then we of course have the US CPI numbers, which is the consumer price index. Now this number will move markets. Okay, although we don't expect drastic changes in the number set because we have seen that it has been quite consistently on the downside. So whether or not these CPI numbers will spike higher, we do not know. But if the market do release the number that shows that inflation is flying up again, then obviously there will be a situation in which the Federal Reserve will be very circumspect in attempting to cut interest rate further. Okay, then the following day on Wednesday we have the PPI number, which is the producer price index. Again, there's no estimate, but the one that will move market will be the retail sales. Like I always mention, the US economy is made up of 70% retail sales. So they do expect retail sales to bump up from zero in October to 0.4, which is marginal improvements, okay? But again, retail sales has been very weak going forward. And of course, in Australia on Thursday, we also be expecting their labor reports. No estimates here. And to round out the week, we have Germany releasing their inflation numbers, which is called the Harmonized Index of Consumer Prices year over year for December. Again, no major changes at 2%. So these will be what data set to look out for the coming week, which may or may not move markets. Okay, but by and large, you can see that other than the CPI numbers and retail sales for the United States, the rest of the numbers are actually quite normal. Okay, so we will start to explore the equity index. Again, we will only be concentrating on the four major US equity index, in particularly the Dow Jones, the S&P 500, the Nasdaq 100, and the small cap Russell 2000. So these are the four major index that that's actually being watched by market players. So we'll begin with the Dow Jones. Now, here what I'm showing you is the tradable futures contract out of Chicago called the Micro E-mini Dow futures for the March delivery. Here we can see that overall, you can see there are green boxes, meaning to say that this market is there is a bias to the upside. The market is still very, very much in that bullish phase. And then we also have fresh all-time high on Wednesday. Okay, so Wednesday we see a new all-time high in the Dow. This is also reflected in the futures contract for the March delivery via the Micro E-mini Dow futures. Here we can see the market is now flirting with 50,000. Okay, in the cash index, the market has gone above 49,000 for the first time. So we can see going forward there is that expectation now. Based on this methodology that I'm using, you can see that the market has hit its target at 49,616 with a high of 49,879 in the futures contract. So going forward, can the market go higher? Of course it can. Now, based on what I think it is showing here, there is the possibility of a 1, 2, 3, 4, and we are part of the 5 right now. And meaning to say, if this is what I think it is, then the market has the potential to actually extend a little bit higher into this bracket between 52,300 to 56,300. So this is a very wide catchment area. So if the market do continue to edge higher, this will be a good area for me to look for reversal signals. Whether or not we can continue to buy depends on the individual. I'm still holding my long position from last week, so I intend to ride this a little bit higher. But I'm very, very concerned about the ending of this cycle here. So once the market goes into 52,000 to 56,000, I think there is the heightened risk of a reversal. Okay, so do watch out for extended move in the equity index futures for Wall Street itself. So by and large, we still maintain a somewhat bullish outlook. There is no counter trend on the daily time frame. So until if you're looking for potential reversal, look at the 4 hours or perhaps even a 1 hour time frame to see if you can catch any early sign of a potential reversal. Okay. Then in the Micro E-mini S&P 500 futures, again for the March delivery, we see something very, very similar to the Dow Jones itself. We can see that this is very much a bullish market here with fresh new highs being traded in the S&P 500 above 7,000 for the first time with a high of 7,017.3 quarter. Okay, by and large, the market has a potential to extend higher into this bracket between 7,654 to 8,350 area. So again, very much like the Dow Jones, I do see the potential for an extended rally into this bracket of prices. And if both index, including the Dow and the S&P 500, hit this pocket here, then obviously the risk of a reversal will be a lot higher, because both charts are showing us basically the same thing. The bias is to the upside, and there's potential for extended rally in both indices. Now, this is by far the best performer for 2025, which is the Nasdaq 100. Now, here we are referencing the Micro E-mini Nasdaq 100 futures for the March delivery. Okay, here we have something very different. Okay, we do see that the high traded for the Nasdaq 100 was actually traded on October 29, 2025. So it actually picks at least 2 months ahead of the other two major index, which is the Dow and the S&P 500. Here we have a counter trend that is currently playing out. So whether this will lead to continued consolidation remains to be seen. However, if they do continue to consolidate, there is a potential for the market to actually advance lower, perhaps to the 23,700 area. Okay, but by and large, it is still very positive. And if we do see an extended rally beyond 26,400, then the market has the potential to at least goes to 28,500, possibly even to 29,300 to 32,600. So again, overall, there is a bias to the upside, although we do have a bit of a counter trend that is currently developing for the last 2 months. Okay, so let's see how this is going to be playing out. The valuation of tech stocks has been so high that market has been a little bit careful about chasing the tech stock higher. So this is the reason why we can see that the Nasdaq 100 is going into a little bit of a consolidation, unlike what we see in the growth stocks, which is represented by the Dow. Okay, so the last one will be the Micro E-mini Russell 2000 futures again for the March contract. Now, this is the one index which I am very positive for 2026 because I think President Trump is going to get what he wants, which is lower interest rates. There are a few considerations. One is that the current chairman of the Federal Reserve, Jeremy Powell, term ends in May. So there is every likelihood in the next couple of days, perhaps President Trump may actually release the name of his new nomination to take over the Federal Reserve chairmanship. Okay, so if that is the case, then there will be two voices: the outgoing and the incoming. So if a new chairman is being nominated, obviously we will give more weightage to the incoming federal chairman. Okay, the one that's going out will be a lame duck. So meaning to say he will basically be in rush aside. Okay, his views will not carry as much weight. Okay, so again, like I said earlier on in January, we're expecting the FOMC, and sentiment and expectation is that the Federal Reserve may actually hold interest rate at the current 3.75%. So no interest rate cut is expected, and if that's the case, that may prompt the president to actually release the name of the new chairman ahead of time. And if that's the case, this is putting pressure on the Federal Reserve to quickly cut interest rates. Because President Trump has already mentioned any future chairman of the Federal Reserve would have to cut interest rates. And that's the reason why I think he's going to get what he wants. Okay. But whether lower interest rate is going to result in the ability to actually influence long-term treasury bond yields, I don't think that will happen. Okay, we have already seen since the Federal Reserve started to cut rates in the last quarter of 2025. Three rounds of rate cuts of 25 basis points did not move the needle one bit. Meaning to say the 20 years and the 30-year bonds yield remains elevated. So it did not move the needle. Okay, I think at the end of the day, what President Trump wants to do is to get the Federal Reserve to cut interest rate. Hopefully, it will lower the yield so that he can refinance the mountains of U.S. national debt, currently at $38.4 trillion at lower interest rates. Okay, he may get the Federal Reserve to cut rates, but I don't think it will move the yield on the long bonds significantly to make it matters. Okay, so this will be the pressure because we have seen how foreign buyers are staying away from the treasury auction. So what now? Who is buying the U.S. Treasury bonds? We have the Federal Reserve coming back into the market to buy the lower end of the yield curve. Okay, basically the Treasury bills, which are anything below 1 year. Okay, so what President Trump wants to do is to roll over the debt for the longer dated bonds, which is not happening. So the U.S. Treasury has been rolling over the debt based on the Treasury bills, and this is a problem because every so often, 60 days, 30 days, they will have to issue new bonds to roll over those that they have previously bought. Okay,